want today to delve into the latest eFinancialCareers report on compensation in the financial services industry with none other than the CEO of eFinancialCareers, Peter Haley. As we all know, 2023 has been and continues to be a challenging year for financial services professionals. This comprehensive survey-based report is a valuable guide both for candidates and recruiters and is compiled from 3,500 responses, very recent responses between February and March 2023, and it spans across all the major financial hubs, the US, UK, continental Europe, and in Asia, Singapore, and Hong Kong. Let me welcome Peter Haley, who has a very impressive background. He's been with eFinancialCareers for 5 years. In the past 2 years, he is the CEO. Peter also serves as an investor and advisor on a global platform called the Get Optimal that is focused on promoting diversity and inclusion in job ads and candidate selection. Welcome, Peter, and thank you for being with us to discuss this financial services salary and bonus survey.
Thanks so much for having me, Effie. Really delighted to be here.
Now, let's dive into some of the key highlights and maybe some surprising insights that the report has to offer us. I want to start, Peter, by looking at the revenue-generating job functions in financial services like sales, trading, and investment banking. How are these job functions, these professionals compensated this year, 2023, which obviously has been and continues to be a challenging year? Did they feel the squeeze? Does the data show us anything surprising?
Yeah, I mean, the data clearly shows that those in the revenue-generating functions are the least satisfied with their compensation. I mean, we know that the market worsened through 2022. So for us, it's not that surprising that they aren't that happy. I mean, we ran a survey around compensation expectations for this bonus round in Q3 of last year. And we felt that expectations were really high in comparison to what we were seeing in the market. So I think what was surprising is that the investment banking division's pay seems to be relatively flat year over year, and actually up on a median perspective. So it would seem that the investment banking division has kind of been cross-subsidized by stronger revenues in sales and trading. And also the increase in the median would suggest that senior bankers have forgone some of their bonus to protect the bonuses of more junior bankers. Sales and trading respondents were particularly unhappy. I think many felt that they had a really good year last year. I mean, you can see that those revenues were strong, but their bonuses didn't really reflect this. I think what was surprising to us also was that the most satisfied of all were the equities researchers. Now, we've got a couple of theories on this. They saw big increases in 2022, so still probably 23 in comparison to 21, it still looks okay. But also, if you think about, we're in a tougher market right now, and so salespeople need a story to take to their customers, and obviously the research functions really provides that. So we believe they're probably being protected in a tough market because they bring a lot of value when maybe the transactions are less.
Interesting. I want to now switch to the other side of financial services, looking at operations first, that definitely have felt insecure in their jobs, and
Yeah.
This is well documented. It's expected, I guess, with all this task automation that is accelerating. What about their compensation and in general, the other job functions that are non-revenue generating in financial services?
Yeah, I mean, really interestingly, they're the most satisfied with their pay of the non-revenue generating positions. So in our survey, over 49% were actually satisfied with their pay. Now, according to our data, they are the lowest paid of the non-revenue generating roles. So, they're almost on a par with compliance, but 12% below kind of broader financial roles, 17% below risk, and 20% below tech. So, they're at the bottom end of the scale. But really interestingly, we predicted uncertainty for this area. But actually, if you look at Q1 job numbers, they've been really robust. We believe that's because there was a lot of new products created, especially on the buy side in 2022, and they require operations functions to scale those products. So actually, whilst there is still long-term uncertainty brought by the digitization of the sector, actually it's been, as a function, it's been more robust than we expected. So yeah, it's definitely some differences to what we kind of expected in the first half of this year.
There is a lot of nuance and detail that's extremely valuable in this report. And I mean, obviously, if we had unlimited time, we would cover all those details. But in the interest of time, let's focus on a couple more what I think are important topics. Talking about the overall working conditions in financial services, especially in terms of long hours, which our industry is well known to be notoriously long hours, especially in in investment banking. Has anything changed there? Any improvements, or overall, whether it's working hours or compensation packages that have improved?
Well, definitely working. Our data shows that working hours have improved. I mean, the function that captures all the headlines is the investment banking division, right? So we saw juniors speaking of 100-hour work weeks, in 2021. So actually, what we've seen is that in investment banking division specifically, the average has gone from 70 hours per week to 60. Which is a meaningful reduction. I mean, it's still a very long working week in comparison to the norm. And we see that's been driven by a couple of things. So increased hiring through 2021 and the first half of 2022, but also, deal flow has reduced. So yes, they're still working very long hours, but there has been a correction.
The pressure isn't there from overload.
Exactly. Now, to most people, a 60-hour working week would still be pretty high pressure, but obviously there's a definite correction. I mean, next up, kind of equity research at 55 hours and trading at 51 hours. So, it is still a kind of, high pressure environment. But when you move to the non-revenue generating areas, you're talking about the low to mid 40s. So, overall, there has been a push back into the office through kind of 2022 and the start of this year. So I think that is a change to a kind of an unwritten benefit, as you like. And we're certainly seeing kind of comments around that people would really accept lesser pay for more flexibility from a kind of hybrid working perspective.
Very interesting to hear that it's happening in financial services, because it hasn't been, that similar to other industries, right? Let's talk about tech and quant jobs in our industry, because obviously as you already mentioned, in 2021 and maybe half of 2022, there was clearly a talent shortage for these types of skills. Now we are in a different situation with all the sizable tech layoffs from big tech companies. The question is, are financial services, the big providers, taking advantage of this softening and recruiting talent? And how has this affected the pay and total compensation of these job functions?
Yes, they have. I mean, especially if you look at the second half of 2022, where big tech was making all those layoffs, and if you think about the locations of, of where that talent sits for some of the major institutions, they were definitely getting a benefit from a cooling of the market. That said, engineering and quant roles are still hard to fill. So it's not like it's become easy overnight for financial services firms to fill those roles, but the cooling definitely helps. And what we saw kind of first half of 2022 was, technologists especially able to command 20% plus increases for moving roles. That's definitely a dynamic that has changed. So that's probably had an impact. But I think what we are seeing is that there is more nearshoring going on. I mean, there's always been a move to an offshoring perspective, but I think the nearshoring to lower cost locations than, say, London, New York, Paris, to enable technologists to work more remotely, if not entirely remotely. So there are there is a bit of a correction there on the tech salaries. I wouldn't say technologists are getting huge pay cuts. Certainly, their base salary has been robust. I think one thing to note that financial services needs to be aware of, and your kind of real experience in the fintech space, there's definitely grumbles from technologists within traditional financial services around the tech stack they're working on. And we know that's ultimately very important for technologists, for both job satisfaction and future-proofing their skills. They want to be working on cutting-edge technology. So there's definitely, individuals in the comments through the survey that are putting that out.
What about the buy side versus the sell side? I mean, let's concentrate a bit on the buy side and what the report shows there, because the buy side has always been a kind of darling of financial professionals.
Yeah.
Does the report show any kind of evidence of myth busting of these sort of perceptions?
Yeah. Well, I think, interestingly, the average pay between the two is almost identical. When you take into account hours worked, and then there is more of a differential, but there's certainly not the differential that maybe individuals think. I think, it would suggest that you're expected to work less hours than if you're on the sell side. And I think, it probably was a little surprising how close the kind of average comp was. But the buy side is still really attractive, right? When you think about benefits around kind of, culture, working practices, and the career path that you can take as you move to the buy side is still very, very attractive. So I wouldn't say just looking at the pure kind of average compensation tells the full story. I mean, obviously, once you get into some of the kind of real success stories, there are the pay and the perks available on the buy side are still pretty significant.
Especially since the sell side doesn't have any more the proprietary trading opportunities post the global financial crisis.
Exactly.
Yeah.
Less regulation. There's all sorts of different factors at play that do make in a natural career progression for lots of individuals.
So that includes both the hedge fund industry and private equity
Yes.
industry that is really alive and strong in terms of.
Yeah, absolutely. It's very aspirational I mean, they're very hard to get into, right? So but obviously, if you have a background within one of the top tier investment banks, that really does stand you in good stead typically. So it's quite a well trodden path to cut your teeth on very long hours at one of the leading institutions, and then move to the buy side.
Yeah, yeah. Peter, if we look overall at compensations, breakdown, the percentage of salary versus bonuses, you know, I've had the first part of my career on the sell side, and it was always the case that the bonus was had a much larger weight than the salary. Yeah. I assume that that's the case, but how are the differences of the revenue generating jobs, you know, the sales trading and so on, versus the non-revenue generating jobs, those proportions, how do they compare these days?
Yeah, it's still, as you suggest, the kind of revenue generating positions, as you would expect, are far heavily weighted. You'll be pleased to know, or anybody cares about regulation and compliance. Compliance are the least weighted from a bonus perspective, according to our data, so 19%. If you then look at the rest of the non-revenue generating positions, you know, operations, risk, tech, they're around 25% weighted toward bonus, with quant and broad finance both at 32% in the survey. Then once you get into the revenue generating positions, you've got kind of equities research at 35%, investment banking 39%, and sales and trading, as you would expect, is the highest at 48%.
Up to what? Up to 60%?
Well, so on average, it's at 48%, but once you get to a more senior level, it really ratchets up. So yeah, kind of the average is 48%. But I mean, there's obviously stories of traders who are earning more than bank CEOs, and they can kind of sometimes skew the numbers. But yeah, it's really significant. And again, back to my point earlier, that's why these are the folks who are perhaps not as happy right now, because they've got more weighted on the variable, and so when bonuses are less are cut, then they feel it more.
Yeah, yeah. Either this compensation or report has a lot of detail. I mean, it covers 9 job categories. We mentioned some of them: sales, trading, all the way to operations. It looks at 5 job levels, you know, from analyst all the way up to managing director. It looks globally to the major financial hubs, and then the buy and the sell side. Can you share with us whether the data points to what are the best sort of jobs in financial services?
Best being a very subjective term, right? So I think if you break it up into kind of the best paid, clearly in the report shows that you know, the most paid by hours worked is clearly those in sales and trading. I mean,
No surprise there. No.
Yeah, exactly. But you know, obviously, hours worked are pretty significant, and the investment banking decision gets a bad kind of rap in this area. But if you think about the investment banking division, your opportunities beyond your immediate role are really significant, right? So, whether that's, we talked about moving to the buy side, but you see a lot of investment bankers taking on really kind of, pretty impressive careers in totally other industries, moving to, fintechs, etc. So there's, there is a real attractiveness around the career path. If you've been working on, M&A or ECM, DCM. So if you don't want to work 50 plus hours a week, then the quant roles, typically are the best kind of beyond that, and at risk is really well paid for the amount of hours that you work. So those roles, depending on, your requirements for engagement with either the sales function or customers, you might get more flexibility as well. So I think what was really interesting in terms of location was that actually at the junior end, Europe's actually surpassed London in terms of pay, and at that junior end of the market. New York.
And also, Peter, when I was looking at the report, it seems that there's more democratic fairness or better distribution across, the very junior functions and the higher managerial functions in Europe.
Yeah, in Europe and in Asia, actually. So the differential between an MD versus an analyst is much closer in Europe and Asia versus New York and London. So yeah, you're right, actually. I think so. The data also shows that once you get to director MD level, London and New York are still far ahead of Europe and Asia Pacific. So yeah, for sure, there's definitely more equity across the roles, or across the levels. Sorry.
Yes, yeah. Well, Peter, I mean, as you said, best jobs is very subjective, and obviously it depends on the point of your career that you're at, in terms of what these valuable insights, offer us. And again, there's subjectiveness in the culture and the career path and so on. But it's an evolving market. As we said in the beginning, it is a challenging year for many industries and for the financial services industry, but there are a lot of opportunities at the same time. And this compensation report is really, I would say, a report that sheds light on knowledge that is not known, is not well understood, and there's a lot of detail in here that is very valuable. And I'd really like to thank you for the insights that you shared, and for the work that the eFinancialCareers is doing in this industry that is really in an evolution, right? A big transformation.
Yeah, thanks, Sophia. I really enjoyed the conversation. I hope some of your followers and viewers got some value from some of those insights. I mean, that's what we're trying to really do, is empower individuals to make better decisions, whether that's organizations trying to attract talent or individuals thinking about their career.
Thank you very much, Peter.
Thanks, Sophie.